Hello and welcome to Portfolio Matters, weekly update, week 66. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
It's another packed week. Okay, first of all, news. Well, the ECB left its key rates unchanged at 0%, even as Eurozone inflation continues to hit new highs. And reminder, the ECB's deposit rate is minus 0.5% still, and they continue to do QE in the form of the asset purchase plan. Canada and New Zealand, in contrast, raised interest rates by 0.5%, Canada to 1%. EU is planning to ban Russian coal starting in August, and Shanghai and much of China is currently locked down and people confined to their apartments and very unhappy about it. And obviously that is having a big knock-on effect on the Chinese economy, which we will go through. Okay, so this week's economic data, well, we had some inflation data. In Germany, the CPI hit 7.3%, which was in line with forecasts. German wholesale prices, though, exceeded forecasts and hit 23.6%.
And just chipping in there, Keith, what was the forecast 12 months ago? Remind me.
Yes, absolutely. Not much. In the UK, CPI hit 7% in line with forecasts, but core CPI was only 5.7%, well up on February, but slightly below forecasts. RPI hit 9%. And UK earnings growth in February was 5.4%, which was slightly below expectations. So UK workers are seeing an erosion in their purchasing power. They're having negative earnings growth currently. In the US, core CPI missed expectations, but still 6.5%. That is core. And headline CPI exceeded expectations, and it came in at 8.5% in March, slightly above expectations of 8.3%. Reminder, the Fed has an inflation target of 2%, and its policy rate is currently 0.33%. And last item is the US Michigan Consumer Confidence Survey, which actually ticked up this month. So we have preliminary figures for April, which came in at 65.7, well ahead of expectations of 58.8. So the market was expecting consumer confidence to continue declining. Instead, it ticked back up slightly, but we'll show you the chart in a bit. Remember, 100 is neutral. So US consumers still feeling very pessimistic. Time for some charts. Richard.
Thanks, Keith. So we talked about Chinese PMIs last week, and they are continuing to look unhealthy and trend downwards. It's a chart we've commented on for seems like forever now. German inflation rate looking dangerous, I would say. UK average earnings. I saw an article this morning on the news, a teacher saying she couldn't afford to pay her rent and she was having to go to food banks. And I think there's you take, if you say that actually inflation is around about 10% for many people, they earn 35,000 a year, their take home is, I don't know, 25, 28. They've suddenly lost 12 to 15% of their income. And if they were basically just making ends meet, they are now in serious financial difficulty. It's a big, big problem. The UK unemployment rate still trending downwards, suggesting the economy is ticking along quite nicely. But of course, we also have, as the US has, we have a fairly increased non-participation rate since COVID. UK CPI inflation, RPI, I mean, also US core, all these graphs just look very, very unhealthy. US CPI, US retail sales, are they falling over is the question. Where is the US economy? Consumer confidence survey. Yeah, well, we'll have to watch where it goes from here. And current conditions are not looking that great.
Ticked back up a tiny bit
Yeah.
last month, but you know, that's not a happy looking chart.
No. Initial unemployment claims, I mean, we have to say basically that these haven't changed very much since late January, and it is at the moment it's pretty stable. And continuing unemployment claims, they're still, you know, the trend is still slightly downwards.
Great, thank you, Richard. Okay, new section, Crisis Watch. We have talked many times about how high food and energy prices will cause stress for developing nations where poor people spend a lot of their income on food and much of the rest of it on energy. And we are seeing unrest around the world. So Lebanon is out of wheat. Its last shipment of wheat from Ukraine was damp and unusable, and now it has no more wheat. So expects some sort of political crisis in Lebanon to develop quite soon. Reminder, Sri Lanka defaulted on its debts this week, and it will use its foreign exchange instead to buy food for the people. In Peru, we've had 6 dead in unrests, and reminder, it's a socialist government which is corrupt and incompetent. This week, the Prime Minister had to apologize for praising Adolf Hitler, and is suffering from food price rises and fuel price rises, leading to lots of unrest. And now on to Inflation Watch. So this week we had new data in the UK, the US, and in Germany. And so we've had in this table March data for everywhere except for Japan, and in all cases inflation still continuing to rise, and to rise sharply as the disruption from the Russian invasion of Ukraine starts to come through into the inflation data. Reminder, EU inflation 7.5% in March. It's still doing QE. Its main policy rate is 0, deposit rate minus 0.5%. Now, thank you to Simon W. for sending this. This is a breakdown of the US inflation components. And if you're interested, pause and take a look. What it paints is a picture of broad-based inflation. The energy component is extraordinarily high, but even if you exclude food and energy, you're still seeing inflation around 6.5%. So it's broad-based. And if you break it down into subcomponents, you'll see that a lot of it in March was actually gasoline, but positive contributions from many other sectors. And something we've talked about many times is the rental component, which is are based on a survey rather than actual hard market data. And this chart shows that rental inflation is much higher than the US rental CPI component. So expect the CPI component to keep rising and to push the headline CPI number higher.
So this chart is showing the market's expecting inflation to slow, but also remain at nearly 6% over the next 12 months. This is based on the 2-year break-even price. The interesting thing, of course, is that basically prior to January this year, the inflation expectations were between 2.5% and 3.5%. And have been completely wrong. So it does pose the question of what is the validity of the US debt market in terms of its ability to evaluate future rates of inflation. And we believe one of the fundamental reasons for this extraordinary level of inflation we've got is because monetary conditions are extraordinarily loose. So we still have QE in America. We have extraordinarily low interest rates, very significantly negative interest rates. And under those conditions, effectively, asset prices rise because the value of the money in which they're priced is falling. And that's what we're seeing here. And interestingly, I read an article this week, Keith, talking about real interest rates after the Second World War. And in some countries, real interest rates fell to minus 60%.
Yeah.
So there's precedent for real interest rates to get significantly more negative over the course of the next months and possibly years.
Well, the thing I'd say about that, Richard, is after the Second World War, lots of Western economies were heavily controlled, and people, because of the war, were willing to accept financial repression of that extent. I wonder whether they'd be willing to accept it now. Well,
the interesting thing is, of course, Keith, if you look at Germany, for example, they're already accepting, depending on what your view of the real inflation rate is, anything up to minus 10%.
Well, we have a section on German Bunds coming up, Richard, when we will discuss that.
And here we are, real rates are negative. And they have been more negative, but they haven't been more negative in basically our lifetimes. And maybe I'm subtracting 10 years from my age there, Keith. You know what I mean. And they are even more negative than they were in the big inflation periods of the 1970s. So this is not a happy looking chart. And there we are. They show this chart every month, every week. And they continue to rise. And there is no particular reason that I can see that they will stop at some point, but there's no great event looming that says that's going to be the peak of inflation. And the ECB deposit rates remains minus 0.5%. So if you just pop back to the previous chart, Keith, assuming ECB doesn't change its rates, then Spain is heading for minus 10% real interest rates. Germany, Italy, and France aren't that far behind. And this is the big conundrum, isn't it? Do we move into a wage price spiral? And the tighter the employment markets are, the more likely that is to happen. But also, we have spoken before about how the world is relatively deunionized from where it was in the 70s. And one of the causes of the wage price spiral in the 70s was unionization and the organization of labor. But there's a big incentive now for people to rejoin trade unions because their standards of living is falling quite rapidly, particularly in the public sector where pay rises simply aren't affordable. So I think one of the next stages may well be that we start to see across the Western world, the developed world experiencing these inflation rates, increasing industrial action for higher wages.
Yes, I can see that as well, Richard. However, I would also say that I am expecting that these high inflation rates to quite rapidly lead to a crisis in consumer spending and hence demand, and force Western economies into recession, particularly given the US is now tightening rates quite quickly. We're expecting them to tighten rates by 0.5%, is it next week?
Yeah.
So,
and then of course that feeds through into the very damaging effect of that on government finances, which are very stretched already, and the general financial health of these economies. So we talked about US rental inflation and how that is bound to impact significantly the rate of inflation in the US in the next few months.
It's also the fact this is still rising, Richard. It's up 17% year on year and not coming down.
I have to say it's a jolly good wheeze on behalf of the Bureau of whatever the Bureau of Statistics, isn't it, who create the inflation numbers to actually lag this figure, because it will come in as the gasoline price, as I think you rightly point out, as the gasoline price falls out. So it won't actually spike inflation rate. Of course, what they will have to do is when inflation starts to fall, they'll have to swap this around and turn this into a leading indicator.
How cynical you are, Richard. So what this chart shows is that over 1 year, US consumers are expecting 5.4% inflation, but over 2 to 5 years, 2.5%. So that probably means that they are not going to be too militant about demanding high wage rises.
And the latest Office of Budget Responsibility UK inflation forecasts. Actually, we're getting these. The pink one is it's not 45, 90 degrees, is it? It's almost 180 degrees that it's coming down at. They've changed the slope of their future expectations, Keith.
Yeah. The peak progressively gets further away in time and higher, Richard. This is their March forecast. I wonder what their April forecast is going to look like.
No, I mean, I think forecast is a misnomer, isn't it? It's just a bleeding guess based on what they hope it'll be. Well,
yes. They haven't done very well so far, certainly.
Fertilizer prices, yeah, I mean, this is... and the problem with this also is that it is now, I heard people talk about this is also going to severely impact the 2023 harvests. And the food price index has hit another new high. And the pace at which it's rising is extraordinary. I mean, it's dangerously high, isn't it, Keith? This is really, really unpleasant.
Yeah, and I should also point out that this is figure for March, and how quickly is the disruption from the war in Ukraine going to be reflected in these prices? You suspect that is not fully discounted yet.
Yeah. Average semiconductor lead times. And I know this is clearly a lagging indicator with what's going on in China with the lockdowns. I would imagine that this is going to get worse, not better.
Yes, but also this just hasn't got better. We think that global supply chain problems have eased, but actually they haven't.
No.
Okay, on to Invasion Watch. This is last week. This is this week. Notice much difference? Russia has made some small progress in the east, but not really very much. And as you will all be aware, yesterday, Ukraine sunk the Russian flagship of the Black Sea Fleet, and I don't think the Russians are very happy. And I suspect that was one of the reasons that oil had a bit of a spike yesterday. That could lead to an escalation. Russia has so far refrained from, let's say, carpet bombing Kiev. This could still escalate. We are now day 50, and it doesn't look like this war is ending anytime soon.
The Russians, they also have another problem, I think, Keith, that Turkey closed the Dardanelles to military naval ships at the start presumably under pressure from NATO at the start of the invasion of Ukraine by Russia, which means that Russia, they can't replace the Moskov, whatever. And so it was clearly their flagship on the Black Sea. It's unreplaceable. And presumably one of its roles was to support the smaller ships, to defend the smaller ships. It's also a guided missile cruiser. So presumably it was implicated in the missile bombardment of,
yes.
Of Ukraine. And it's humiliating for the Russians.
It certainly is humiliating, because I've read commentary which talks about you'll be aware the Ukrainians claim to have blown it up with a Neptune missile.
Yeah.
But the Moskva had essentially 3 tiers of anti-aircraft / anti-missile protection, the last of which had various super machine guns which would fire 5,000 rounds a minute and blow anything that was approaching the ship up. And they all failed. So
it is yet another indicator that the Russian military is not what it has been purported to be.
Absolutely. Okay, following on from our earlier discussion about the Eurozone and the ECB, are German bunds losing their safe haven status? Now, I have been very struck by how quickly German bunds have sold off. Now, we talked earlier about how German inflation was rising sharply, and the ECB was doing nothing about it. So it has done absolutely nothing to raise rates and counter inflation, as inflation has massively exceeded its target 2% level. As a result, the market seems to be losing confidence in German bonds as safe haven assets. So this is the 10-year inflation expectations for Germany as measured from their index-linked bonds. Now, we talked last week about how the ECB is trapped. If it raises interest rates, it first of all have to stop its asset purchase program. And in raising rates, it would then expose the periphery to market forces, leading potentially to a return of the Eurozone crisis. So what it's choosing to do instead is keep interest rates essentially at zero and continuing to buy the bonds of the periphery, so Italy and Greece and others, and suppress spread in bond yields between Germany and the rest. But that means German interest rates are wholly inappropriate. So reminder, we saw this chart earlier. The interest rate in the Eurozone is just wrong.
Interestingly, Keith, so Christine Lagarde, I think yesterday, but it might have been Wednesday, came out and said the ECB will do whatever it is necessary to maintain stability in the Eurozone, financial stability in the Eurozone. Now, when Mario Draghi did that back in 2012, was it? He could actually do it because he had the ability to basically print vast sums of money to keep the Eurozone afloat. But the problem with Lagarde saying it is there is no credibility to that statement, because they have to both raise interest rates hugely, remove QE, and at the same time flood the economy with large sums of money to make sure that the peripheral countries don't go bankrupt, and the two are simply contradictory.
Yeah.
So she can't do whatever it takes.
Well, what she's doing now is prioritizing Eurozone integrity over financial monetary stability. Now, the question is, are the bond markets going to take this out of their hands? So if the bond yields start rising towards 10%, then actually a lot of the budget deficits in the Eurozone become unsustainable, in that you then have to, when you need to refinance those bonds, your interest rates rise. So the ECB is going to try and suppress yields. At the short end, they can do it, but at the long end, they're in the control of the market, and they have the potential to lose control.
Yeah, it's also a strategy of hope, and the hope is that the inflation rate drops. If the inflation rate drops significantly for external factors, then effectively that saves their bacon.
True. And actually, we do expect them to come down, because I'm expecting recession. Okay, so in conclusion, German CPI this week hit 7.3%, but the ECB's deposit rate remains minus 0.5% and continues with QE of around 40 billion a month. As you've just seen, the ECB's balance sheet continues to grow and is now second only to the Bank of Japan's. So it seems to me that bond investors are beginning to question whether bunds are a safe haven. And as the bonds of Eurozone economies start to sell off, then that would seem that the ECB is losing control of the narrative.
So now having a look at what the effect of rising bond yields is likely to be, and whether we think it will provoke another financial crisis. So if we look at global debt in US dollars, it has risen inexorably from 2015. Actually, it's risen inexorably from way before then. And as a percentage of GDP, it's now around about 350%. And that is only sustainable because interest rates are so low. And now the market is finally starting to wake up to the fact that the Fed is serious about raising rates. And I think the Fed is serious about raising the rates. And the Fed does a lot of jawboning to try and make the market react in advance of what it might do to save you having to do it. But right now, I think it genuinely intends to raise interest rates up to 6 or 8 times over the next year or 2 years, at potentially up to 0.5% at a time. And so the market is saying, well, this time the Fed is serious. So whilst the federal funds target rate is now 0.5%, the 2-year is actually priced as if it were 2% and going up. And of course, corporate yields have been very low for a long time. And I remember back at the start of my career in finance, first company I worked for we had debt, and it was at 15% normal, and that was the norm. It wasn't exceptional, it was the norm. And where would 15% be on that chart? Well, apart from the spike in 2008, it doesn't feature. Shows you how long ago I started. So the rise in corporate yields could be extremely dangerous because there isn't the free cash flow to service a significant increase in corporate yields. So it could be extremely dangerous to the corporate sector. And I think we have to say not just the corporate sector, but small businesses as well. Any business that is carrying debt. And this is a long-term trend. It's a lovely chart, isn't it? You know, it's a long-term trend of the US 10-year. And basically, it's followed this downward trend for the best part of 40 years. But at each time it comes up and hits or pokes through that downward sloping trend line, something happens. And what is it that happens? So in 1987, there was a stock market crash. 1994, Orange County Mexican currency and banking crisis, aka the tequila crisis. In 2000, the dot-com bust. 2007, the great financial crisis. In 2018, Volmageddon, the Christmas Eve massacre. And if you remember at that point, the Fed introduced the most enormous repo facility. And it's never really been publicized, but there was a view that they saved the financial system from collapse at that point because it was about to seize up. And so if we just go back to that chart, here we are in 2022. We're well above the trend line. Interest rates have risen in relative set terms hugely, 50, 100% increase over the past few months, which is in relative terms an enormous increase, especially if businesses are borrowing at the margin of affordability or borrowed at the margin of affordability. What will the next crisis be, is the question.
Thank you, Richard. This chart shows the performance of US Treasuries, the US Treasury future. You see it's coming off incredibly quickly. And last time it came off this quickly, there were big crises. So had Orange County back in 1994. And then in 2000, we had the tech.com bust. Now, the question is there a forced seller? The speed with which it's coming off is indicative of somebody selling whatever the price. So is there actually already an ongoing crisis that we just don't know about and we'll discover in due course?
And I think the enormous size of the relative change in interest rates and therefore the relative pricing will, if someone is the right side of it, they'll make a lot of money. If they're the wrong side of it, they will lose a lot of money. This move has been huge. Yep. It might be a 0.2% interest rate change, which we think is pathetic, piddling, but in relative terms, it's enormous, and we have to understand that. So the conclusion, some of the crises had relatively minor consequences, such as the tequila crisis and Volmageddon, and others were extraordinarily serious, 1987, GFC, and the dot-com of 2000. So it's not a predictor of the severity of the crisis, but it is a predictor of something seriously wrong. And as rates will continue to rise, which we know they will, it will cause increasing stress for highly indebted entities, including governments, as it happens, that need to refinance their existing loans. So we know that's going to happen. And so there is the potential for rising rates to cause a new crisis, particularly given the enormous levels of indebtedness that we now have. And if you think back to that chart of debt versus GDP, that is much higher than it was for any of the other crises apart from the Volmageddon. And so as it states at the bottom here, it's not really will it provoke a crisis, but what will the crisis be and at what level of interest rates will it occur? Indeed, is it even fermenting now? And it is, and as interest rates fall, it is unavoidable question. And now Keith is going to take us through the tequila crisis of 1984.
Well, as
this was one of Keith's worst hangovers, wasn't it, Keith? Cut that bit.
So when we were going through those crises, I had to remind myself of the mechanics of the tequila crisis of 1984 and also of Volmageddon. So next week, actually, I'm going to go through Volmageddon. This week, we're going to do the tequila crisis. So the tequila crisis was a Mexican currency debt and repayment crisis. And if you look here, you see the blue line is the upper bound of Mexico's currency peg. It had a crawling peg at the time. The orange line is the bottom edge of the peg, which never came into play. Essentially, you'll see that in 1994, the Mexican peso traded at the upper end of the crawling peg as investors lost confidence and then kaboom. Mexico couldn't maintain the peg and the peso went free floating and promptly lost 35%. In fact, actually, over the course of 1995, it more than doubled. So, yeah. And these are Mexican's foreign exchange reserves. You'll see how there was a massive capital outflow throughout 1994, leading to the crisis at the end of 94. And then the IMF came involved, and rebuilding of confidence through government austerity measures led to renewed inflows, helped by the fact the Mexican peso had halved. And these are foreign holdings of Mexican equities, and you'll see huge outflows. So huge hot money outflows throughout 1994. Okay, so what caused this crisis? Okay, so its origins go back to 1982. And you remember that this is the period when Paul Volcker was raising US interest rates to 15%. That had absolutely enormous knock-on effects for emerging markets. If you could get 15% investing in the US, why would you invest in emerging markets? So there's a huge emerging market debt crisis. And in 1982, Mexico nationalized the banking system. But then, moving forward to 1992, so 10 years later, Mexico has joined NAFTA and therefore has eliminated most capital and exchange controls. But in order to reassure investors, has pegged the Mexican peso to the US dollar. Then in 1992, it decides to re-privatize the banking system. But when it re-privatized the banking system, it wanted to ensure high privatization proceeds, but also the continuation of soft loans to politically favored entities. Therefore, it stopped foreign banks from bidding, stopped foreign banks from actually competing in the Mexican banking system, and it sold off roughly 70% of Mexican banking assets. So what you had was a monopoly sector that was protected from foreign competition, and they allowed essentially anyone to bid for a bank. You didn't have to have any experience in the financial sector. So potentially incompetence running the banks. As you might expect, a huge credit boom ensued. There was also deregulation, and the new regulator was inexperienced, didn't really know what they were doing, so just let everything go. So the consequences were, you'll see here that the far right-hand column, by 1996, 50% of Mexican banking loans were in default of some kind, default or restructuring. So huge bad debts. So the background is bank deregulation, huge credit boom. That was in 1992. In 1994, crawling peg starts to come under pressure. The US is raising interest rates at this point. Mexico is having a general election, which is contested and fraught with political violence. There's a series of assassinations. Investors start to lose confidence in Mexico. In response, Mexico issues US dollar debt. So it's saying to investors, don't worry about the Mexican exchange rate. We'll repay you in US dollars. And it issues these tesobonos, which are short-term US denominated debt. Now remember, short-term debt is dangerous because you rely on the capital markets always being open so you can refinance them on demand. Then in November 1994, $3 billion leaves the country as investors start to lose confidence, and 1.8 billion departed in a single day, the 18th. Then in 1994, new government, the new government tries to reassure investors they're not planning to devalue the peso. And just the phrase devalue the peso leads to a crisis in confidence, so that the next day 855 million leaves the country. The government then tries to raise interest rates to 15%, but essentially it's just not credible. In the lead up to Christmas, 4.6 billion leaves the country, i.e. half the country's FX reserves. And on the 22nd, the government gives up and the peso is allowed to float, and on that day settles down 35%. So there was then an IMF rescue package, followed by a US orchestrated 50 billion rescue package, and that allowed Mexico to repay its Tesobonos. Otherwise, it would have defaulted. Then in March 1995, the new government launched an austerity drive, and that reassured investors, and money started to flow back into the country, as you saw from the earlier charts. So this is the performance of the Mexican economy, and you'll see in 1995 you had a 6.2% drawdown, a big recession, and inflation hit 35% in 1995. So a big recession. So in conclusion, whenever you see deregulation, that always leads to a big credit boom and a subsequent financial crisis. But relevant to us now is the fact that rising US interest rates cause huge stress in emerging markets. And the speed with which US interest rates are rising is going to be causing a lot of stress in EM. We've seen Sri Lanka default on its debts this week. Watch this space. This could get a lot worse.
Yeah.
Finally, crises occur very quickly. You know, the speed with which the Mexican debt crisis occurred took everyone by surprise. You were losing, in the course of 2 days, Mexico lost half its FX reserves. And then the next day, it had to let the currency float. So you need to be early, or you need to be very fast.
Yeah, and I think that's really interesting, Keith, and thank you very much for that, because I think understanding how crises of the past operated helps you have an insight into what might happen this time around, but also, as you say, gives you some clues as to what you need to do to protect yourself, because you can't actually predict either when or what the crisis will be. And as we probably all know, moving fast is very, very difficult for a private investor to do, because we do not have access to the markets in the way institutional investors do.
Yes,
and moving
absolutely.
fast is inevitably, when everyone else is trying to move fast the same way, very expensive.
Yeah.
Historically, when people start talking about recessions, it's been a good time to buy shares. And this chart, it shows the -3, -1, 1, 3, 6, 12-month returns around the point at which recession news spiked. And as you can see, the -1 month returns pretty bad, and the +1 month returns are actually far better. And then you can work your way out and see. So the question is, people are starting to talk about recession. Is now the time to buy? That is the question. And as it says at the top, PM view, this time is different. And it's different because valuations are so high, and there's so much uncertainty in the financial system, and interest rates are going to go up, we think, relatively, by a very large amount. Keith?
To recap, I just don't think Europe can escape recession. So we're seeing massive increases in food bills, in energy bills in particular. And we're now also, so Europe is going to suffer from just huge stress. In the US, you're seeing the same things to a lesser extent, but interest rates are now rising very rapidly. And the point of interest rates is to slow the economy. you need to keep on raising interest rates until you reduce demand and therefore reduce inflation. And the US has now started doing that. So I saw this and I thought it was quite interesting, but I also really wonder how they measure when a recession news spike is. But I'm actually, although my personal portfolio has had a very good few weeks, I remain very nervous about equity markets because I think a recession is inevitable.
I think you're right, Keith. I would completely agree with that. The question is that in the past, the S&P has made gains up until 6 months before the start of a recession. So I guess the question they're asking is the fact that the S&P has stopped making gains an indicator of a recession? And it may or may not be, I guess. I think there are stronger indicators or stronger reasons to think there might be a recession than what the S&P is doing. What do you think, Keith?
Well, economists were forecasting recession next year. So on the one hand, this chart would seem to suggest that the S&P can continue to make progress until 6 months before a recession. So if you believe that a recession will only occur next year, then you can continue to hold the S&P 500. But I'd also add that I'm currently reading The Alchemy of Finance by George Soros, and which is rather a turgid read, I have to say. But next week, I'll be doing something on reflexivity. And he makes a really good point about the S&P 500's ability to forecast recessions. So the general view is that the S&P 500, the stock market, forecasts recession by about 6 months forward. So it turns down 6 months before a recession, and it anticipates recessions. His view is that the turn down in the S&P is one of the causes of the subsequent recession. It precipitates the recession. So the wealth effect is part of the cause of the recession. Okay. And so actually, I thought that was a really interesting point, and reassured me about letting my portfolio essentially run. Essentially, it is true that the S&P 500 turns down before recession, so don't worry about a recession. Worry about the stock market.
Interesting. Of course, the theory behind QE now, I don't know whether it was the theory at the time that Bernanke started it, but the theory now is that the reason it works is because it creates this big wealth effect. And the problem is that the US and effectively the EU have created such a big wealth effect that they can't now get out of it without creating the equal and opposite.
Absolutely. So further to our previous chart, this just shows that economists are forecasting a 50% chance of recession next year, but actually not much of a chance of recession this year. So if you believe the last chart, that the stock market only turns down 6 months before a recession, you should continue to hold equities for a bit.
Although with the caveat that economists aren't very good at forecasting anything.
Yes, very good point, Richard.
So post-lockdown US demand is still booming. So we have total employment, the pale blue line, up, continuing to rise for the last 14 months or so. Personal consumption, new manufacturing orders, and retail sales all rising rapidly from January 21. No sign of a slowdown. And US freight transport prices are dropping quite quickly. The thick blue line has dropped from, it's dropped about 30%, in fact, in the last few months. And clearly that has to reflect either a much increased supply of transport or a much reduced demand, or some combination of the two. And I guess this is part of that same story, that the S&P Transportation Index is falling fast. And the same comment really, but the transportations do tend to be a harbinger of where the economy is going over the near term.
Absolutely. But I thought you raised a very good point actually about supply. As we know, there have been loads of new trucking companies formed in the US as a result of the supply chain difficulties.
Yeah.
So it could well be actually just a supply shock.
Yeah, difficult to tell at the moment, isn't it? Just a factor to bear in mind. And the Long Beach queues are slowly declining, which suggests that the ports have got their act together and possibly the amount of goods being shipped is reducing. Yeah, inventories have gone to a glut. Basically, people saw their inventories were very low. They were very concerned about having very low inventories, and they have now overordered, aka the beer bottle supply chain game,
which we covered many weeks ago on the weekly. And excess inventory is bad for the economy because you're going to have to slow down your new orders as you work through your inventory backlog.
So this is a chart showing the US consumer delinquencies, subprime auto and retail credit cards. The retail credit card, probably just has ups and downs. Subprime auto is looking like there is some stress in the system. It's a sharp, clearly delineated upward trend in defaults. High yield bonds continuing to fall in price, suggesting that, as we covered earlier, the market is concerned about creditworthiness of these businesses, particularly with interest rates rising. In some senses, a self-fulfilling. This is an interesting chart which sort of shows some type of correlation between employment and recessions. I think it does show a correlation, to be fair. And that it's a lagging indicator, i.e. the recession starts and then employment starts to fall. We are not seeing that lagging indicator yet, and we won't see it until after we've entered recession.
Yes, exactly. So every week we cover US employment, which looks great, but actually it's not a very good forecast of a recession.
Goodness, this is an interesting chart, isn't it? 250 years of UK productivity growth, all the way up until 1970. And then, our productivity growth has ceased, and we are now actually, according to this chart, our productivity growth is slightly negative, which means that our national wealth is going in the wrong direction.
Yes.
For the first time in 250 years, which is really, really very unfortunate. Yeah, I mean, this is a question with all asset prices, and houses are just part of, property is just part of this. The value of the currencies throughout the developed world have been significantly reduced by quantitative easing. Therefore, you need more currency to buy any particular asset. I mean, I think that is the interpretation one has to put on what's going on with asset prices everywhere. That's certainly the interpretation that I put on it.
Yeah. Well, I look at these charts, Rich, and I just think the value of housing is just absurd. As a multiple of people's earnings, it's got completely unanchored from reality. And coming back down will cause vast amounts of financial stress for a lot of people and institutions. So worrying.
So we used to show these charts all the time during COVID, and sadly we're back here, but this time it's Shanghai, and obviously Shanghai is shut down because Chinese are trying to stop the spread of Omicron, which apparently has an R number of 12, which means it is unstoppable. It's so infectious, it really is virtually impossible to stop. But the Chinese are trying to stop it nevertheless, and probably will totally fail. They've got themselves into a mess, really, with this, a real mess. And clearly this is indicating that Shanghai is shut down, and the Chinese commodity imports are slowing because Chinese manufacturing is shut down. And there we are.
Okay, thank you, Richard. On to the weekly checklist. So first of all, equities. Well, generally an indifferent week for equities. FTSE All-Share down 0.2%, S&P down 2.5%, NASDAQ down 3.9%, and now down 15% on the year. And as we discussed many times over the course of this podcast over the last 18 months, you would expect long duration assets like tech to do very badly as interest rates rise. And that forecast is finally coming true. And now we had a request from longtime viewer and occasional contributor Michael Byrne to stick in a Chinese index. So we put in the Hang Seng. And the Hang Seng ain't doing so well, down 1.6% last week, down 8% year to date. And Bitcoin also had a bad week, down 8%, down 13.5% year to date. And the dollar continues to climb, which will put more stress on emerging markets. Have a look at the next one. Okay, so this is a really interesting chart from Hussman Strategic Advisors, and it shows their indicator of the equity risk premium and the subsequent 12-year return for the S&P 500 in excess of T-bills. So the amount that the S&P 500 outperformed bonds. And you'll see the last time that their indicator was this low, the annual return over the next 12 years was minus 5%. So is this a good time to be buying equities, we ask ourselves?
The question could be rephrased slightly to be, what equities would this be a good time to buy? Question mark. And there is a potential answer is, none.
True. Yes, it's the broad index and it disguises lots of different sectorial returns, obviously.
So this chart is showing that US earning forecasts are rising very slightly in the white line, which means that analysts are still forecasting corporate growth. And in Europe, they're rising even more, which is actually quite extraordinary given the inflationary pressures that Europe is experiencing and the fact that there has to be some degradation of margins due to the vast increases in energy costs. I think this just looks completely wrong to me.
Yeah, it looks delusional to me.
And we have some big sectoral differences where earnings upgrades for energy sector have been huge, as you would expect. And industrials, consumer discretionary are at the other end of the spectrum, as you would, particularly with industrials, as you would expect. So US corporate earnings calls increasingly mentioning wage pressures, which we have been talking about wage price spiral, and that suggests that businesses are experiencing pressure from their employees. That's back to our discussion about unionization, organization of labor, and simply that real earnings are falling quite significantly at the moment. That's interesting. And that is actually slightly contradictory to the inflationary expectations graph that we saw.
So what do you mean?
So the inflation expectations graph said, survey said people within the next 12 months are expecting 5%, but thereafter low rates of inflation. It's slightly contradictory data, I would suggest.
But it also suggests that companies are very worried about their margins.
Yeah.
So, when analysts are still forecasting that corporates will be making very good profits, well, if they have to raise wages, then they should get a margin squeeze.
Yeah. I always think this is a very worrying graph. I mean, we've seen it a few times. We haven't seen it for probably a couple of months now, but the private investors' margin accounts, and these are very labile. So the first hint of serious market correction, they will sell their margin positions, and that's an awful lot of selling.
Yeah. Thank you, Richard. Okay, on to commodities. And reminder, we're at the start of a hiking cycle, and during hiking cycles, these are the performance of various asset classes. So commodities tend to do best. You don't want to hold bonds, and actually equities aren't that bad. 6 months after the first hike, they're still made 7.5%.
We also have to bear in mind that chart that shows that if inflation is above about 6%, then inflation is bad for equities. And we are at that point now.
We are. Yes, very good point, Richard. And mining sector profit margins are at an all-time high. Okay, on to energy commodities. And first of all, I thought this was an interesting survey. So this is a survey of adults asking them whether their country should shift away from fossil fuels. And you'll see that there is global agreement that we need to transfer away from fossil fuels. And that means that supply of oil may well be constrained going forward, which perversely will be quite good for the oil price, because we all say we don't like oil while continue to burn it and record amounts. Okay, so on to some data. Well, it was a great week for oil. Oil bounced back after last week's fall. Brent was up 11%, WTI up 10.9%. Dutch natural gas futures continued to drift off as Russia continues to supply Europe. But reminder, they're still up 36% on the year. Coal had a great week, up 10% on the week, up 85% in the 3.5 months of 2022. Uranium also continued to drift higher, up 2.7%, and up 48% year to date. Okay, numbers that matter for the oil price. So, well, actually slightly concerning figures. Including the Strategic Petroleum Reserve, we had an inventory build of 3.5 million barrels last week. So if the oil market is tight, why is there more supply than demand in the US? And excluding the Strategic Petroleum Reserve, that was a build of 7.3 million. Concerning for oil bulls. US crude production was flat and the Baker Hughes rig count ticked up too, but it is up 66 year to date. Now, reminder that increasing the rig count now, drilling more wells will have no effect short term. It takes around a year to drill a shale oil well. You then need to complete it, and then you need to plug it into the system. All that takes about a year. So drilling a well now will add supply in a year's time. This is crude chart, strong bounce back this week. Now, what's interesting is that there's been a complete collapse in open interest in oil futures. Now, you know that the volatility has led to a big increase in the margin rates. So is that funds reducing their positions simply because of the volatility, or because they are losing confidence in continued rises in the oil price? Now, Bloomberg are reporting that last week, Russian seaborne crude flows actually rose to a 2022 high. So that would completely upend the narrative of sanctions constraining Russian crude flows. This is something to watch. But other sources show Russian crude exports have fallen. Their estimates are between 300 and 750,000 barrels a day. And what is absolutely true is that Russian Urals blend is trading at a huge discount to Brent, which suggests they're having to offer big discounts for people to take it. So,
although big discount on the current oil price is still a tidy profit for Russia.
Yeah, absolutely. And that discount is not just in Europe, but also in Asia, suggesting that Asian buyers are also reluctant to buy Russian crude. And the other concerning thing, and going back to our earlier point about US inventories rising, is that US petroleum products supplied have been falling over the last few weeks. And that's very concerning. That suggests high prices in the US are actually causing demand destruction. So that's bearish oil. And these are the components. So you see, finished gasoline has actually been coming off. So less driving, distillates also coming off sharply. Potentially quite concerning for oil bulls, frankly. These are Dutch natural gas futures, still massively elevated. Best part of fourfold rise over the course of the last year. This is coal, which continues to rise strongly. India has rising coal production, but its power demands are still outpacing its increase in coal output, which means that it's likely to have power outages this summer. Thank you to Simon W. for sending us these charts. So its coal inventories are falling and it's warned of power cuts this summer. So the coal market is tight. This is uranium. Richard will be happy. Industrial commodities, Richard.
Thanks, Keith. So a quiet week for some and a hectic week for others. So basically, aluminium fell 3%, but still 17% up year on year. Copper, cobalt, chromium, no, not much of a significant change there. Iron ore, lithium and magnesium all had decent sized falls, and magnesium is now down 25% nearly on the year. Neodymium, having had that enormous run up, is unchanged on the year. A bad week. And then nickel is bouncing around basically. I think it seems to have found its natural level after that epic short squeeze that we saw, up 58% this year. Tin down a little bit. Ferrovanadium, big upswing this year, but a reaction this week, so it's dropped down a bit. And then zinc up significantly, 5% for the 25% year-to-date change. So moving in all sorts of different directions at different speeds, these guys this week.
Well, the thing is, the sell-off in commodities, industrial commodities, is inevitable given lockdowns in China.
Yeah.
So your end customer is basically not buying anything. Of course, the commodity is going to fall. The question is it more than that? But there, you look down the weekly change column, it's noticeable. They're almost all negative, apart from zinc.
There's aluminium, cobalt, copper, and this is the copper production versus projected consumption. So there's a big gap there, which means that is long-term bullish for copper producers. Chromium, iron ore, lithium, just coming off slightly.
Is that the peak?
Probably. Magnesium, neodymium, falling back substantially actually from its high peak. And nickel, weird looking graph. Tin, ferrovanadium, and zinc on a bit of a tear, zinc. So moving on to precious metals, good week for precious metals. We've gold up 2.2%, silver 4.3%, platinum 3.2%, rhodium almost unchanged, palladium up 3.6%. So the moves for the year, rhodium and palladium really quite substantial, 36 to 25%. Gold and silver, a decent sized move, but not anything like the size that we have seen in other commodities.
Yes, but actually decent moves. They're looking like safe havens given the rise in inflation.
Yeah. So it's gold, silver, platinum, rhodium, palladium.
Okay, thank you, Richard. And finally, on to rates. Now, rates have really started to move in the last month. And this week we saw continued sell-off in bonds, so rates rising across the curve. So in the UK, we had a rise across everywhere. All the 2 years up 10 basis points, the 30-year up 18 basis points, and that is a big move in context. So the whole yield curve is shifting upwards, and as we talked about earlier, that will put a lot of stress on heavily indebted entities. In Europe, in the periphery, Greek bond yields rose slightly. Italian bond yields also rose on the week, up 16 basis points. Now, next week, Stuart Owen has sent me a really interesting chart pack about Greece, and we are hoping to record that via him dialing in from Tokyo to insert into next week's weekly. So watch this space. A reminder, value of global bonds is the yellow line. The white line is combined balance sheet of the Fed, ECB, and the Bank of Japan. So the growth in world debt has been the growth in world debt has been facilitated by central bank largesse, i.e. they've been buying loads of it. Okay, so this is the UK 10-year, and that is not a happy looking chart. That is rising in a straight line. And this is the US 10-year, also not a happy looking chart. But we are now in late April, and it's a strong period for the stock market. The seasonality chart says stay fully invested. Richard, how was your week?
Thank you, Keith. So I had a reasonable week. My 1 week change was up 2.1%. That puts me 8.5% up for the year, and a relative performance of 7.9% against the FTSE All Share. As long-term viewers know, a lot of my portfolio is in precious metals, and they had a good week. The precious metal shares had a good week, and also my oil shares had a decent week. As did my uranium shares. So a good week for me. I sort of talk briefly about gold. So this is a weekly chart of gold from 2015, and you can see that since mid-2020, when it peaked at $2,080 an ounce, I think that was what it peaked at. It's been in what chartists would call a consolidation, but it was forming a flag, and it has broken out of that flag. And the question is this, having broken out of it, is it now going to continue to go up to a new high? The geopolitical, inflationary, and systemic uncertainty in the financial system suggests that it may well do. And I am holding on to my precious metal shares on the basis that is what's going to happen. And this is a chart of gold mining stocks against the gold price over the last 35 years. And clearly history is not necessarily a guide to what will happen at this time around, but it is substantially below the long-term average, like 1/3 of the long-term average, and about 5 times the peak, which occurred in the late 1990s. So this chart suggests that the precious metal mining sector has substantial rise potentially within it. And obviously, we shall wait and see. And this was a little snippet from yesterday's Financial Times. So we view the German economy as being very powerful and vibrant, and it is actually supported by the fact that the euro is a relatively weak currency for an economy as strong as the German economy, and it's more set to the level that is required for less weak economies, which means Germany has a very significant benefit. This article in the FT was basically saying that German CEOs can't manage their companies because the corporate structure that has been imposed on them by regulators over many years makes it impossible for them to make decisions that allow them to move their companies swiftly if they need to move their strategic direction. And I would suggest that Germany is now in precisely that position. We have massive increases in raw material prices. We've got a large shift in geopolitics, and there will be German businesses out there that need to make rapid strategic shifts. This suggests they will struggle to do so, which is not a good sign for the German economy if it's the case.
Very interesting. Thanks, Richard.
And Keith, how was your week?
Well, I had another good week. I was up 2.9% on the week, and that takes me to plus 21.8% on the year. So I'm having a very good year.
Very good.
I have to say that I've been very nervous, and I haven't actually been enjoying this rise because it has been so sharp that I've been really wondering about how long this trend can continue before we go into a recession. But actually reading the George Soros book has reassured me. And to me, it is still definitely a period in which I am holding on and waiting to time my exit. But I'm actually reconciled to just doing that. And recap, my exit plan essentially is to sell in May and go away. So this week I sold a little bit of Empyrean Energy, and that was it. So Empyrean are currently drilling the Jade prospect offshore China. And I managed to sell my little stake in Empyrean, and I've been selling it in small chunks at 12.6, which is well above any point on this chart because I put in limit orders. So I've sold a little bit at 12 and a little bit at 12.6. Now, regular viewers will know that we had a total disaster earlier in the year when Advance Energy drilled a dry hole. And I then subsequently did some work, thank you once again to Simon W. for this, that showed that wildcat drillers, in fact, the whole of the oil industry tends to massively overestimate the chances of drilling success. So my aim is to try and sell Empyrean before the drill result comes in. And so every time it spikes above 12, I sell a bit. And I have been puzzled over the course of the last couple of weeks as to why my portfolio has continued going up even when the oil price was going down. Well, I think this explains it. Essentially, investors are rotating out of tech and bonds into commodity stocks, which we showed you the charts earlier, their profit margins are at an absolute record, but their valuations are still quite cheap. So I am continuing to be long and will just sit on my hands. It's a question of timing the exit. And okay, I think that is it. So thank you all for watching. Happy Easter. Please can you press like and subscribe to the channel. And in the meantime, it's goodbye from Richard Wheater.
It's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision.
We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.